Many people have utilized cryptocurrency arbitrage to make a lot of money in a less risky way than traditional trading methods like swing trading or day trading. So if you're intrigued about this subject and haven't looked into it yourself, don't worry because I've put up an overview of this topic for you. All you have to do is carry on. This is Crypto Coach, your host once again, and I hope you enjoy your stay on our channel as we strive to provide you with useful and interesting content about the cryptocurrency market despite the current bear market. Before we begin, I would appreciate it if you could support my work by hitting the like button and subscribing down below if you haven't already. Okay, so let's get started and learn more about cryptocurrencies. In order to engage in arbitrage on the highest level, you must first identify an asset with different pricing across marketplaces, despite the fact that it is the same item. Examples of such an asset include stocks and bonds. If you buy an asset in one market and then sell it for a profit in a different market, you're basically taking advantage of a risk-free trade, which makes it difficult to find in the traditional market because so many people are already taking advantage of it or have systems set up to do so, making it difficult to find in the traditional market. To maintain pricing stability across markets, most arbitrage trades are now performed by automatic systems, so retail traders like you and me no longer have much advantage. To put that into perspective, there are over 200 crypto exchanges with widely differing prices. Just visit coinmarketcap.com to see this huge price range in the crypto industry. Click on a coin and select markets to see all price differences that are caused by imbalances in supply and demand, as well as price discovery for each exchange. Larger exchanges with liquidity drive the price and smaller ones follow. But it's not always immediate. Sometimes the big ones change and then the small ones are slow to catch on, which is where arbitrage opportunities exist. For example, a kimchi premium is a good illustration. The kimchi premium is a classic example of arbitrage opportunities that existed during the bull run of South Korea's Bitcoin market. If Bitcoin was selling for X dollars here, it would be worth even more in South Korea by an additional 30%. Arbitrage can take a variety of forms. In case you're interested, we'll look at the simple form as well as the Fiat Triangle arbitrage, the crypto triangular, convergence, and catch and carry. Simple arbitrage is a relatively straightforward process. Coins are purchased on one exchange and then sold on another. However, it takes time to transfer coins between exchanges, which is why it's possible to earn a spread, which is the difference in prices. Having fiat and crypto balances in both exchanges allows you to purchase and sell efficiently on one exchange in a different one. Here is an example of how this works in practice. In order to make $100 profit, you can buy 50 Litecoins on Binance and sell 50 on Coinbase, which is now trading at $60 and $62 respectively. Now let's talk about Fiat Triangular arbitrage, what it is and how it works. This is when you have three assets or two asset pairs involved with one shared asset between the pairs. For example, Bitcoin USD and Bitcoin Korean Won both have Bitcoin as a shared asset, but there are still three total assets that we're dealing with here. For example, you could buy one Bitcoin for 30,000 other Coinbase, send it to a Korean exchange, and sell it for 42,000 worth of Korean Won. Exchanges that serve local or regional markets frequently have the ability to take advantage of this opportunity. It's also possible to execute triangular arbitrage with crypto, even on a single exchange using mispricings between three pairs of coins. For example, Ethereum Bitcoin and Litecoin Bitcoin form a singular triangle of mispricing. You can use arbitrage to your advantage if you remember or check out on coinmarketcap.com, which lists the ratios between various cryptocurrencies in USD value. As an example, let's say you want to convert Ethereum to Bitcoin or Litecoin to Bitcoin. Since the supply and demand on these two markets are completely different, it makes sense that the prices would be different. You can take advantage of this price differential in terms of USD value by going through the pairs, and there are bots available to help you do this. After it comes convergence arbitrage. Because of market inefficiencies, prices will ultimately converge due to other individuals taking advantage of arbitrage opportunities. You can buy this coin on an exchange where it's undervalued and then short sell it on an exchange where it's overpriced. Of course, you must find an exchange that enables shorting of that particular currency. Here's an example. If I can buy Litecoin on Gemini for $51 and then short it on Kraken for $56 when the price converges, I'll make a profit of $5. Of course, shorting is complicated and not for newbies, so please do a lot of study and testing before you attempt this. The last one I want to go through is the cash and carry arbitrage, which is possible because of the futures market. Essentially, you go long in the spot market or other markets that we are all familiar with, and you go short in the future market. After that, you carry the asset until the futures contract expires, and then you settle it with your long position. Because of this, you can pocket the difference when you deliver the item, so it's a very profitable strategy. As an example, if the CME or CBOE future price for Bitcoin is 4,300, but the current price on Binance is 4,000, you can buy it on Binance and then short it on CME and then deliver the 1 Bitcoin when your futures contract expires and get paid 4,300 for it. Cash and carry is common, but digital assets don't have a carrying cost in the traditional sense. Simply keep it in a physical wallet, either on an exchange or even better in your own wallets, and then deliver it when your futures contract is active. So, if you haven't heard of bots, they are a significant element of arbitrage, and they can help since computers can do this better than us when it comes to algorithmic trading. They can execute complex rules fast and accurately, saving you time and hassle so you don't have to sit at your computer all day looking for chances and manually executing them. In terms of their emotional impact, they aren't prone to panic selling or panic buying provided they are coded properly and have safeguards in place. You can code your own bot if you're a programmer, but if you're not, you can pay for them or subscribe to them online, but beware of scams. The more people that use them, the less effective they get, and that's true for every technique, box or regular. They used to perform well during the last bull run when there was a lot of efficiency and volatility, but now there's not as much. What distinctive opportunities for arbitrage are there when a coin is put on an exchange? For example, if you look at Binance, every time a currency is listed on Binance, it spikes in value. This is an opportunity for arbitrage between Binance and other exchanges that already list a coin. It's also important to note that price differences between countries are a big deal because access to those is often restricted. For example, in Korea, there are big price differentials, but if you don't have the necessary credentials, you can participate in the Korean exchange. This is a big deal. Another factor to consider is liquidity, which can make it difficult to take advantage of arbitrage opportunities on smaller exchanges because of a lack of liquidity. So there are many downsides and risks with everything you do in the crypto space or financially in general. Here are some exchange risks. Withdrawal limits, KYC requirements, and hack funds if you put your funds on exchanges. Execution risk due to volatility. Like if you put in an order for X amount of Bitcoin, it may not be filled since it's too volatile. Low liquidity, as I previously stated. You can't execute your trade rapidly at your preferred price. Risks of network congestion or wallet upkeep. This is a major deal if you need to transfer it for your arbitrage strategy to function. Also, fees must be computed and taken into consideration when calculating prospective profitability. The maker-taker fees, how much are deposit withdrawal fees, credit card payment fees, whatever strategy you prefer. In the Netherlands, you don't have to pay taxes on every transaction, but in the US, you must. So that's something else to consider when practicing arbitrage. The most important thing to remember while attempting arbitrage is to carefully plan your trades and ensure that they are executed fast. Reduce costs by using the correct currency conversions and transactional processes. Keep an eye on the crypto industry for news and other possibilities. Be aware of what's going on around you. Transferring money at a faster rate if you must send money. Consider using using Ethereum rather than Bitcoin or another cryptocurrency with less network congestion at the moment. Have a well thought out strategy in place and be aware of the gold price difference. In addition, how much money do you plan to invest in this strategy? Make sure you're comfortable with the exchanges before you invest a large amount of money in them. Keep your options open when it comes to the currency exchanges and trading tactics you use. Finally, set a limit on how much you expose yourself to risk. It's the ultimate weapon in the crypto universe. Therefore, don't do anything more than you can afford to lose. Alright, so thanks everyone. What do y'all think about this video? I hope it was useful or interesting if you haven't heard about arbitrage before. Once again, you can support our channel by subscribing down below, hitting that notification bell. I want to wish you an incredible day, and this is Crypto Coach saying goodbye until the next time.